Hi student, good day. Our today's topic is intangible asset of our financial reporting. Chapter 3 is our today's topic. Okay. So first of all, I would like to understand what is intangible asset and why it is required in the financial reporting. And but first of all, this is for your information. This is very important chapter in the book, which need to memorize and practice. And in your upcoming question paper, complete question paper, there will definitely a part of question, and you have to understand this knowledge, so which will helpful for you when you have a practice question over there. Okay, the purpose of intangible assets are those assets which cannot be touched, which cannot be feel. Like before previous chapter we did tangible assets, which is property, plant, equipment. We can touch it, feel it, we can visit it, we can evaluate, and everything is can be done physically. But intangible, these cannot be seen, but their presence is there, like a goodwill, like your patent, like your license, your copyrights. So these are intangible assets, and these are more valuable than your other assets. Like goodwill, you know what is worth of goodwill in today's practical life. So we will be discussing today nature and accounting treatment for internally generated and purchased intangible assets. So we'll discuss what is the difference between internally generated and purchased intangible. Like if you buy some goodwill, or if you buy some existing business, so that is called like a purchased intangible assets. And if you internally generated with the passage of time, that is your internally generated assets. So distinguish between goodwill and intangible assets we will discuss over there. And describe the criteria of initial recognition, how you recognize in the books of account, and measurement for intangible assets in your books. Describe the subsequent accounting treatment of intangible assets, and this is an important part. So describe and apply the requirement of IAS 38 to research expenditure and development expenditure. This is also important. So this is a part of our topic today. This is a small chapter, but very important. It part of question can come. Definitely they will test you in all areas of your question paper. Okay, so intangible assets. So like there are three things, like goodwill, which is coming under IFRS 3. We'll discuss about the definition, positive goodwill and negative goodwill. Some companies having a negative goodwill as well, according to the market. Like intangible assets under IAS 13 definition, we'll discuss recognition and amortization, how we recognize in books of account, and how we treat it. Amortization is also a term of depreciation, how we'll depreciate over the passage of life. If you have a license for 10 years for purchasing or copyright or something particularly, so we will amortize it over the period of 10 years. This is a simple example. Research and development, R&D, IAS 38, the definition, accounting treatment, and amortization also applicable to this assets without physical substance, as we discussed. So they don't have any physical presence, and you cannot touch it. But intangible assets include items such as license, quotas, intellectual property, patent and copyright, brand names, trademark. For an asset to be identifiable as a IS 38, intangible assets state that it must be fall into two categories. These two categories need to be fulfillable. The asset can be bought or sold separately from the rest of the business. So we'll explain further. So it arises from legal contractual rights. This will arise as a part of purchasing an entity or entire company. This will be looked at the further in the consolidated financial statement chapter. We'll discuss over there as well. Okay, student. According to the definition of this IS 38, so it's an intangible assets is identifiable non-monetary asset without physical substance. So it doesn't have any physical substance, you cannot touch it. But intangible assets include items such as license quotas, intellectual properties, brand names, trademark, and there are the asset to be identified under IAS 38. So assets state that it must fall into the two categories. It must be aspirable. If the asset can be bought or sold separately from the rest of the business, it can be treated as a separate entity. Assets are like a brand. It's a something like if you have a KFC brand, so brand is a separate separate is a brand, but chicken shop or chicken fried chicken, it can be any company. Non-branded, if you remove the board, so then it is just a normal chicken shop or normal fried chicken. So number two, it says it arises from legal contractual rights. This is a right. This will arise as a part of purchasing an entire company. This will be looked further in our consolidated financial statement chapter. It must also fulfill the following definition criteria: control by the entity as a result of past event, normally by enforceable legal rights. Definitely, the company has a right to, like a franchising business or any copyrights you are taking. So they must have it must be controlled by the company. It must have their past events are there, their past performance. People have a trust. They have a name. They have fame in the market. Everything is part of this. Second saying, a resource from which future economic benefit are expected to flow either from revenue or cost saving. Definitely. So if it is you are taking any brand, or if you are taking any franchise, there is economic benefit will definitely will flow. It fulfill the criteria. Recognition, how you recognize in your books of accounts. So this is the main thing now. So in order to recognize in the financial statement, an asset must meet the this criteria. The definition of intangible assets meet the recognition criteria of framework IS 38. Okay, it provide probable that future economic benefit attribute to the asset will flow to the entity. Definitely. So you have to memorize little bit. This is the key point. Economic future economic benefit attribute to asset will flow to the entity. The cost of asset can be measured reliably. Absolutely, in the market there will be a existence goodwill, and this thing will be available. It is measurable. Purchase intangible assets. If intangible assets are purchased separately, such as a license, patent, brand name, or it should be initially be recognized at cost. Whatever cost you paid for that, it must be recognized at that same value. So measurement after initial recognition, there is a choice. So you have a company or their auditor, their board of director can discuss and method of costing, or they can select cost model or revaluation model, same like a tangible asset. So there is a cost model and revaluation model. Revaluation must be carried periodically for their test. Under cost model, intangible assets should be carried at the cost less amortization and any impairment losses. The model is the more commonly used in the practice. This model is the more commonly used in the practice. Intangible asset with the indefinite useful life should not be amortized. If there is a unlimited life, there is a no it's a part of your business now, it should not be amortized. Then they should be tested for impairment annually and more often if there is an actual indication of possible impairment. So this is the you have to look into these type of categories. If asset fall under this category, you have to follow this rule. Revaluation model is also same like previous. Assets must be revalued at fair value, and should be determined by reference to an active market. And intangible assets may be revalued to carrying amount of the fair value. This is the same way how it is we did for tangible asset. IAS 38 states that active markets for intangible assets are rare and specifically prohibits the revaluation of patents, brand names, trademark, and publishing rights. A guide for indicator of an active market would include the item traded within the market are homogeneous, identical, prices are available to the public. So this rule also fulfill the criteria. So then only you can make a revaluation model in successful way. Internally generated intangible assets, as we discussed earlier, so internally mean it is within the company they build their goodwill, their brand, their any product which is successful, like a cash cow product, or they have publishing rights or titles, customer list. So these are also internally generated, like some companies selling their business to the social, in the social media. So they have contacts, they have past performance like e-commerce. So now these type of things are coming in a days for internally generated. So these can be a goodwill, inherent goodwill, brands, uh, about the publishing titles, customer list is there, masterheads is there. So these type of things can be considered as a internally generated. So brands accounting treatment for brands has been matter of controversy for some in the past years. Intangible asset has now ended the controversy by stating that internally generated brands and similar assets may need to be recognized. Expenditure on internally generated brands cannot be distinguished from the cost of developing the business as a whole, so should be. Okay, students, now we see the illustration intangible classification. How should we the following intangible assets be treated in the financial statement? A publishing title acquired as a part of subsidiary company, a license purchased in order to market a new product. So which one you feel, which one you think according to our just which we discussed? So which category fall under this publishing titles or the license? The publishing title is a answer depend on whether the asset can be valued reliably. If this is possible, the title will be recognized at its fair value. Otherwise, it will be treated as a part of goodwill on the acquisition of the subsidiary. This is a publishing right, the definition or explanation. How the license will be treated? License has been purchased separately from a business. It should be initially capitalized at cost. So license is a straight away. So always whenever you see the license, its cost is there. So you will recognize in the books of account according to this treatment. So goodwill, this is the one of the favorite topic of examiner. It keep coming in your consolidation question. Goodwill part is there. So be recognize, be remember, and memorize this area. Goodwill is a difference between the value of business as a whole and aggregate the fair value of the separate separable net assets. If suppose my business having a value of assets is the 10 million, and market their director demand is a 15 million, and 5 million is a goodwill because of their intangible assets, their market fame, market name. So their all activities are there. Variable net assets are those assets and liability that can be identified and sold off separately without necessity of disposing of the business as a whole. They include identifiable intangible assets such as patent, license, and trademarks. Any company having a trademark, like any mark, like whatever you name it. So this is a simple thing for patent, license, and trademarks. Fair value, how it is identified according to IFRS 13 as the price that would be received to sell an asset or paid to transfer a liability in order to transaction between market participant at the measurement date. So this is a definition. So remember this rule. Goodwill may exist because of the combination of number of possible factors. So these factors are if happen, or then you consider there is a goodwill issue is there. like a reputation for quality or service. Okay, technical expertise, possession of favorable contracts. Okay, if your company having a contract to produce a product for 1 year, so it's a goodwill. So you cannot you start a business and you cannot secure 5 million production from day one. So if you having a business, you're buying such business, it is coming with the contracts and favorable contracts, so definitely it has a value. Goodwill management and staff, and the good management is also there, so that is also a part of goodwill of the company. Purchase and non-purchase goodwill. Purchase goodwill arises when one business acquires another as a going concern, and is understood. Includes goodwill arising on the consolidation of subsidiary. Will recognize a financial statement as a value at a particular point in time. So these are the purchase goodwill points. Memorize. If somebody asks you differentiate the purchase and non-purchase, so you can identify the non-purchase goodwill. It is also known as inherent goodwill, has no identifiable value. It is not recognized in the financial statement. This is unknown, just as a market reputation. This is an important thing. IFRS 3 now for business combination, how it is governed and how it is applicable to the accounting treatment for business combination, and it further it will detail will available in chapter 18. Goodwill, this paragraph is important to understand. Is identifiable as an asset representing the future economic benefits arising from the asset acquired in the business combination that are not individually identifiable and separately recognized. So this is the business combination. So how we will recognize all this. Now research and development, R&D also is one of the main part of IAS 38. Research is original and planned investigation undertaken with the prospect of gaining new scientific knowledge and understanding. So this paragraph is defined by IAS, IFRS. So development is the application of research finding or other knowledge. So this definition is also part of your IAS 38 definition, which you need to understand. Accounting treatment, so this is the main thing. Now main part of your accountant, you are a professional accountant, how you recognize it in the financial statement. What is the research expenditure write off as incurred, the statement of profit and loss. If research expenditure is there, straight away write it off. Development expenditure recognized as intangible assets if only an entity can demonstrate the following. Under development expenditure, these rule you have to remember and memorize. So this is a abbreviation. This is also called pirate. 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 The probable flow of economic benefit from the assets, whether through the sale or internal cost saving. Intention, I for intention to complete the intangible asset and use or sell it. Reliable measurement and development cost is there. Advocate resources to complete the project. If it is incomplete halfway, it will be cost. This is not if it is not fulfilling this criteria. So technical feasibility of completing the intangible assets so that it will be available for use or sale. This is the main key point. If it is not available for use or sale, this is coming under R&D. So this is development expenditure. If it is fulfilling this criteria, so then only. If they in the question sometimes they say, so they stop it during the period of construction or during this way, management change their mind, so straight away expenses out. So expected to be profitable. For example, the cost of the project will be exceeded by the benefit generated. So these rules should fulfill, and then only you will able to recognize. So how the amortization take place? Amortization is just the same like a depreciation. So development expenditure should be amortized over the useful life as soon as the commercial production begins. Okay, so just go through this one and we'll see what is how we will express, how we'll explain it. So, attest your understanding, an entity has incurred the following expenditure during the current year. So, 100,000 spent on initial design work of new product. It is anticipated that design will taken forward over the next 2 year to develop and test it with the view to production in 3 years time. So what is this? The 2 year it will take the new product. It is anticipated that design will take forward over the next 2 year period. Next 2 year period it will take, and then it will be utilized in 3 year time. Okay. See the read the number 2 point. Number two, they are saying so 500,000 spent on the testing of a new product system which has been designed internally and which will be in operation during the following accounting year. This new system should reduce the cost of production by 20%. See, now this is according to our pirate rules. So if we recall these rules which we just now we discussed, so how we will treat this thing, what is the requirement now? So they say how should each of these costs to be treated in the financial statement? Think about it and let's see how it is we are going to consider it in our books of account. See, now there is about first A point, as we said. So the research costs, as they are only in the early design stage and therefore should be written off to the statement of financial position or loss for the period. So it must be expenses out. So there is no, this is early science. So this is a 2 year they spent, and 33 year after they will see according to the production. No, this rule is not fulfilling. Number two, they are saying there would be appear to be a development stage cost as the new production system is due to be in place fairly soon and will produce economic benefit in shape of reduced costs. So definitely it is there, you have to okay student, now we see the illustration 2, how the amortization of development expenditure is happening in this accounting treatment, how the expenditure will be amortized in the books of account. We just read through. Improve has deferred development expenditure 600,000 relating to the development of a new Miracle brand X. It is expected that the demand for the product will stay at the high level over the next 3 years. Annual sales of 400,000, 300, and 200 respectively units respectively are expected over the period. X has sells for sterling 10. How should the development expenditure be amortized? So this is the way how you will amortize in the books of accounts. There are two possibilities of writing off the development expenditure. So write off an equal installment over the 3 year period, for example 200,000 every year. So like 600,000 you spend, 200,000 you expenses out per annum. So the other way, you can write off in relation to the sales expected 900,000 units. So this is 900,000, 400,000, 3 and plus 2 is a 900,000 is there for these assets for the total units. So they will divide it to the 400,000 sales for first year over 900. This much will be amortized this method. Year 2 they can distribute 300,000 production for this one, so they will apply over here. So 200,000 will applicable over here, and then same way 400,000 applicable over here. So this is a way you have a answer, you can explain them. So when we see the revision kit, so we'll have all understandings very clearly. Now we see the test your understanding number 3. So how this is going to be treated in our books of accounts. This is Copper LPLC spent 20,000 research new cleaning chemical in the year December 0, they have also spent 40,000 development in a new cleaning product which will not go into commercial production until next year. The development project meet criteria laid under IAS 38 intangible. How should these costs are treated in the financial statement for Copper PLC for the period December? How they will treat it in their books of accounts? So according to this, Cooper Pierce spends they spend 20,000 in research. Should be written off as incurred. So because whenever it's incurred, the 40,000 should be capitalized, because 40,000 developing a new cleaning unit should be capitalized as a development asset, but it should not be amortized until commercial production begin. So when commercial production starts, then only they can start amortization. Now number 2, which two of the following item below could potentially be classified as intangible assets? Which two are intangible assets? Purchase brand, training staff. Training staff always remembers they're never allowed. Internally generated brand, license and quotas. So which two of item could be potentially be classified intangible assets? Purchase brand, internally generated brand and license quota. So these two will be applicable under this category for this rule. Okay, student. Under point 3, they are asking question is this: Sam company has provided the following information as of December 2006. Project A, 50,000 has spent on research phase of the project. Okay, this is you remember research phase, simply strike out. Project B, 80,000 has spent on the project in the previous year and 20,000 this year. The project was capitalized in the previous year. However, it has been decided to abandon. Abandon means they don't have any intention to continue. So this is also strike out. So project C, 100,000 was spent on the project this way. This year the project meets the criteria IAS 38 is to be capitalized. Excellent. This is a option for the project C we need to recognize in our books of account. So what was their requirements? Which following treatment should be done in your accounts, books of accounts? So one is saying that reduce profit by 70,000 and increase non-current assets by 100,000. No, it is not like that. So reduce profit by 150 and increase non-current assets by 20,000. So they will treat it in this way. So in the books of account, they will make it profit by 150 and increase the non-current assets by 20,000. So the C, reduce profit 130. No, it is not like that. So reduce profit by 150 and increase the non-current asset by, this is not the option. Only option B is the correct one. So under this treatment. Number 4, please go through which following statement concerning the accounting treatment for IAS 38. So research is a original and planned investigation undertaken within the prospect of gaining new knowledge. Development is a application research finding. Depreciation plant used specifically on developing a new product by capitalizing over the development cost. Expenditure once treated as an expense cannot be reinstated as an asset. Okay, so what is the requirement? So they are asking, so which expenditure are true according to IAS 38? So according to IAS 38, which expenses are true according to this one? Like this one. Only research is original and planned investigation undertaken with the prospect of gaining new knowledge and understanding. Only this is not fulfilling this area. Other two are fulfill this area. So in this way of the question 4, the number D is your correct answer. All of above. say I'm for